Hello traders, welcome back to the Forex Gig, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the J-hooks candlestick pattern, a powerful continuation pattern that can help you identify opportunities to ride strong market trends. This pattern is a favorite among traders for its ability to signal high potential entries during the uptrend. Now you have to stay with me until the end of this video, as I will not only explain how to spot the J-hooks pattern but also show you how to trade it effectively and manage your risks like a pro. So let's get started. We start by understanding what the J-hooks pattern is all about. It's a continuation pattern that typically forms during an uptrend. It is characterized by its distinct J-shaped pattern on the price chart, which consists of three main phases. And these phases are: the first phase is where we see a strong upward price movement. As we can see, this is the strong upward price movement, followed by a bearish pullback, signifying that some traders are taking profits. Now we can see this bearish pullback causing price to dip slightly. As we can see, price is dipping slightly because of this pullback. Finally, the pattern concludes with a bullish confirmation as the price resumes the uptrend. This is the basic principle of the J-hooks pattern. Now remember, during the pullback phase, you might notice a round bottom shape. This is a round bottom shape, as you can see from the chart. We notice that the market is in a round bottom shape. If we look well, we can notice it's in a round shape. And this phase is crucial as it represents a period of consolidation. It is crucial because of the consolidation at this area in price. The market is actually deciding the next move it should make. Traders look for signs of reversal at this area in the market. When you see the consolidation in this round shape area, some traders are looking for signs of reversal at this area, and the signs of reversals are: you check for doji candles, you can check for your hammer candle. As you can see, there are hammers, there are dojis, there's doji too, there's still a hammer at this area. These are the reversal patterns some traders are looking for, which indicates that the selling pressure is waning and buyers are regaining control. When we see the reversal signals at the pullback phase, the rounded pullback phase, this shows that the sellers are losing strength and the buyers are gaining their strength back. The final phase of the J-hook pattern occurs when price begins to rise again after the consolidation. This is this area here, when price begins to rise after the consolidation. This is when traders look to confirm their signals to enter their trades. A key confirmation is when price breaks above the high that initiated the upward movement, signaling that the uptrend is likely to continue. That's when price break above this high, signals that price is about to continue. This is what it means. Now let's see how we can implement this to our trading day-to-day lifestyle. To trade this pattern effectively, it's important to focus on timing your entries, confirming the setup, and managing your risks. To enter this trade using the J-hooks pattern, you have to wait for the pullback phase to be completed. Once we notice this pullback phase is completed, we look for signs of potential reversals. The signs of potential reversals are signs like the reversal candlestick patterns, such as our doji, our hammer, our bullish hammering, and etc. These patterns initiate or indicate that selling pressure is weakening and buyers may prepare to continue to push price to the upside. And these are my patterns at this area. We can see my pattern. This is my hammer and my doji at this area in price. These are the patterns we are looking for. If we can look at this area, we can still see a doji at this area. We can still see a bullish engulfing at this area. This signals that bears are losing momentum and buyers are stepping into the market. That should be your entry confirmation, and this suggests that the upward trend is resuming. Now, before we enter a trade, it's essential to confirm the validity of the J-hooks pattern, and there are some key confirmation to add to get the validity of this pattern. The first confirmation is we use indicators. We can use our volume indicator. We can show there is an increasing volume at that area, and as we can see in this area of the market, the volume indicator shows there is an increased volume. As we can see, there is an increased volume in this area, signifying that yes, bullish traders, that the bulls are coming back into the market. We can also make use of indicators such as our stochastic oscillator. We can use our stochastic oscillator to confirm. We can look for an oversold stochastic area. As we can see, price is below the 40 at this region, showing that we are being oversold. This is also a confirmation we can use before taking the trade, and as you can see at the area of the pullback and consolidation, price is being in the oversold region, signifying that bears would soon lose their momentum and the bulls are about to take over. And we also need to confirm that this is a trend continuation. Remember that the general trend is a bullish trend. As you can see, price is trending from the downside to the upside, showing that bulls are in the market. So this should be part of your confluence that the market was originally in a bullish market. Now, when you enter the trade after price has broken above the the resistance region, once price breaks above the resistance region, you can either wait for a test of that area or you can enter when price breaks the structure. Then you put your stop loss. Stop loss placement is very important because risk management is critical when trading in any pattern. For the J-hooks pattern, we have to place our stop loss just below the lowest point of the pullback. Just below the lowest point of the pullback should be where you place your stop loss. This ensures that if the market reverses unexpectedly, your losses are minimized. Now, how do we exit our trade? Exiting our trade is also very important because some traders know how to enter, get the perfect stop loss, but they do not know when to manage their trade by exiting so that the market wouldn't take back the profit it has given them. To exit your trade, one common approach is to set a target to a previous resistance level. You can decide a previous resistance level in chart can be your area of take profit, and to see a resistance level we need to go very far back in price. Okay, this is a resistance level, a previous resistance level. This level at far back in price is a resistance level. Using this, it indicates that we can aim for this resistance level on our chart, proving that market, when it gets to that area, we can take our profit off the table. One other way we can also use is using Fibonacci extension levels at where the price trend might slow down, or we can use a fixed risk to reward of 1:3 or 1:4 or 1:2 as the case may be. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.